Welcome to ETF Market Insights, a weekly show focusing on the evolving world of ETF investing. Each Friday, a new panel of thought leaders aims to provide investment education and insights, with the goal of helping you become an informed investor. Make sure to visit youtube.com/ETF Market Insights to watch previous episodes. And remember to hit subscribe so you receive a notification when we post new content and when we go live each Friday. Thank you for joining us today. Let's get started.
Welcome back to ETF Market Insights. I'm your host, Erin Allen with BMO ETFs. And in today's episode, we're going to unpack the key economic trends that are shaping the second half of 2024. From global market shifts and central bank policies, we'll look at what's driving the economy right now and what investors should be keeping an eye on, and some strategies to weather whatever volatility we may be in store for as we close out this year. Just a quick reminder before we get started that today we are not providing any investment advice or recommendations. Today, just like all of our episodes, is about providing education for Canadian DIY investors. Joining me today is Bipan Rai, our new head of ETF strategy here at BMO. I'm really looking forward to having Bipan on the channel more frequently, so you'll be seeing him come back time and time again, and we'll get his thoughts and explanations around what's going on in the market and ETF strategies to help with your portfolios. Bipan, welcome to the channel.
Thank you, Erin. It's good to be here.
It's great to have you. Your inaugural session here. Hoping we can kick things off and just have you give our viewers a bit of an intro into you and your background and how you came to be our new ETF strategist at BMO GAM.
For sure. I mean, it's an exciting time for me personally to join the ETF world. By way of my background, it's primarily as an investment strategist. I spent close to 14 years at another Canadian dealer as a macro strategist, focused primarily on the world of foreign exchange and interest rates. And of course, the macro does factor in quite heavily into those two asset classes. But being a macro strategist also means several other things that I had to develop expertise on, and that includes a heavy degree of focus on monetary policy, including central bank operations and balance sheet management, the fundamentals, which is really just a fancy way of saying that one pays attention to key economic variables and understands how to contextualize them and interpret them, as well as several other factors that tend to be drivers in the macro space. Also, as part of that, I spent a lot of time talking to different clients, including prominent pension funds, investment managers, and central banks around the world. And from my lens, I've seen a tremendous amount of growth in the ETF space, and the product has really broadened out from its humble beginnings, let's call it, as a passive investment vehicle, and it's becoming more and more essential really to develop or at least understand the macro developments in order to interpret market conditions in the ETF space. And ETFs themselves offer one of the best and easiest ways to understand how to understand and participate in those macro themes. So in this role, I'll be heavily focused on macroeconomic themes and strategies and identifying the appropriate opportunities in the ETF space.
For sure. I'm looking forward to it. And if you're not on our newsletter already, you can sign up on etfmarketinsights.com. The hope is in the future that we'll be able to include some commentaries from Bipan there as well. So hopefully sign up. Let's get into the topic of the day, Bipan. We had this constructive reset or August scare, whatever you want to call it, this rapid market decline at the beginning of the month and subsequent rebound where the S&P dropped around 3%, its biggest drop in one day in nearly 2 years. What are your thoughts around this? And give us your comments around what happened.
Certainly. I mean, it was a scary time to be sure. And it really reflects the new reality that we as market participants are dealing with. There's several reasons for that drop that we saw into the latter part of July and into the early part of this month. The ones that we feel are most relevant include the rapid unwind of yen-funded carry trades, a growing amount of concern that the Federal Reserve, the central bank in the United States, was keeping policy rates too tight. We also had the recent round of earnings that concluded towards the end of July and pointed towards waning momentum on the equity front, particularly so for tech stocks. And of course, there was also the element of geopolitical risk that was emerging again and we had notable escalations in the Ukraine-Russia conflict, as well as the conflict that's going on in the Middle East. So, all those above reasons could be identified as trigger points, but let's contextualize that and remember that those are really just triggers for what we sense is a deeper, more structural change in this current microstructure of the market relative to years past, and that is the massive amount of increase in both leverage and what that means whenever we get sort of these positioning imbalances. I mean, that's an important reason why we can expect to see random chop at various points in markets going forward.
All right, and you mentioned the carry trade, and I want to spend a little bit more time on there. What happened in Japan? What is a carry trade, and what does this really signify in your mind?
Right. So that's a very good question. I mean, the easiest explanation is the one that I'm sure most of our viewers are probably familiar with, based on what they've heard or read in the media, and that is that you had speculators ramping up borrowing in Japan, where interest rates have historically been low, and investing or potentially going long in currencies where interest rates are relatively higher, including places like Mexico or even in developed markets like the United States. So that long Mexican peso, short Japanese yen trade was probably the most crowded trade among FX folk over the last couple of years. But there are other compelling explanations as well for what happened. One of which is what investors in Japan were doing. So remember, for several decades now, interest rates in Japan have been low for a variety of reasons. A lot of that has to do with poor demographics and ineffective fiscal and monetary policy. And unlike households in most of the developed world, including here in North America, Japanese households tend to save a lot more than they consume. And that's meant a massive amount of build when it comes to savings, with relatively few attractive investment income options domestically, given interest rates are generally lower in Japan. So a lot of Japanese investors over the last several decades have tended to look outside of Japan for potential investment opportunities. And that's meant that Japan has become the world's largest exporter of credit. And one way to see this is via the degree of foreign bond holdings held in Japan. That's usually can be seen by the U.S. TICS report, or even Statistics Canada does release something called the International Transactions Report every month. And we can see clearly there that there is a fair amount of participation from Japanese investors for both Canadian and U.S. Government bond paper. But it's also important to note that Japanese investors hedging this currency risk, for them, hedging this currency risk was very expensive. For example, if you look at a 3-month dollar yen forward, that trades at around 190 point discount to spot. That meant that it's, for a Japanese investor that bought US dollars today, offsetting that 3 months later would be equivalent to potentially an annualized loss of 5%, which basically would wipe out most of the income generated from the underlying treasury that they were buying. So it really didn't make sense for a lot of these investors to hedge their FX risk. So a lot of that was unhedged. So what happens when the Bank of Japan does something for the first time in a generation that it hasn't done before, and that is hike interest rates? All of a sudden, onshore in Japan, you have all of these new investment opportunities that you didn't have before. So what that led to was this repatriation of flows back onshore in Japan. That led to a stronger Japanese yen. And if you want to extend that a little bit further, that was also bad news for domestic exporters, which tend to make up a fair bit of the Japanese equity market. So that was the primary conduit towards a stronger Japanese yen, and of course a very soft Japanese equity market that we saw earlier this month.
Very interesting. Thanks for that explanation. It's that whole the butterfly flaps his wing and it causes the tsunami somewhere else or something like that.
Absolutely, yeah.
Talk to us about what happened with the VIX. This is Wall Street's sort of fear gauge or measure of volatility expectations. What
Right.
happened and what have we seen sort of since then in that measure?
Right. So, I mean, you nailed it. I mean, the VIX is a gauge of expectations of volatility in the broad equity market, and using the midpoint of real-time S&P 500 index options. I mean, more mechanically, it's the annualized implied volatility of the S&P 500 stock option with 30 days to expiry. And generally speaking, volatility rises when concerns about the underlying asset um, start to rise as well. And so, VIX spikes have generally been associated with declines in the S&P 500. And a few weeks back, the VIX spiked to a level just around 38, which is well above the long run average of 20. And that's an indication that, the level of fear or stress is getting close to extreme levels. And, if we go back over 40 years on a daily basis, you would only expect to see an observation like that maybe less than 5% of the time. So, to put it bluntly, it was a big deal. And that was reflected in the way that the equity market moved.
Absolutely. All right. So, what are some of the key takeaways for investors that we can glean from this little market hiccup, if you will?
Right. So, I mean, I mentioned earlier that trigger points, it really exposed how much leverage is in the financial system now relative to where we were, say, 10 to 15 years ago. That isn't a theme that's going to go away anytime soon. I mean, the increase in leverage it is primarily due to years of access to cheap funding and deeper pools of liquidity that really extend to how much larger central bank balance sheets are now relative to where they were, say, pre-2008. What this means is that something as simple as a positioning bounce could become a major issue, and that could be, the drawdown in the equity market, and the sort of concerns that we see arising from time and time again. Those could become more frequent and potentially lead to sort of deeper drawdowns and quicker recoveries as well. And keep in mind also that when we do see these instances of volatility spikes, the positive correlation between stocks and bonds increases, which obviously is a big concern for anybody that still puts a lot of faith in the traditional 60/40 portfolio. And in that sort of environment, we can't stress this enough. You want diversification that extends beyond that 60/40 approach and looks at alternatives to provide that ballast. And I like using that word for portfolio to ensure that you're protected when times do get rough. And again, we could be in for periods where these sort of sell-offs become more and more frequent when uncertainty levels remain high and positioning becomes excessively skewed.
So, set yourself up in positioning so that you can sort of weather these shorter term blips, because we all know that staying invested over the long run, these will all get ironed out and you're better off. Panic can be
Absolutely.
costly. But I'm curious, in terms of our audience, I'd love to hear from them in comments below. What did you do? Did you sell? Did you sell out? Did you panic sell? Did you stay invested? Did you buy the dip? Comment below and let us know. Bipan, can you give us some insights in terms of what we're seeing in equity market valuations, maybe in the US and beyond, and how that's looking right now?
So certainly on a broad level, we could look at current levels of valuation, and of course I'm relying on the traditional price to earnings gauge, and come back with the conclusion that broad equity markets are somewhat overvalued. But in my mind, it's still very much important to put this valuation in context to where we are in not just the economic cycle, but also the market cycle as well. And sure, at in our broad S&P 500 level, you look at price to earnings ratios, and we're fairly elevated relative to where we have been over the past several years. But at a more sectoral level, I mean, there's still room for opportunity and really room for value plays to do reasonably well. And certainly if we look at say the consumer discretionary as a sector, that's overvalued according to some metrics, and it feels like that should be a sector that underperforms. Again, when you look at valuation gauges, we should really contextualize them with where we are, not just in the economic cycle, but also the market cycle as well. For instance, at this point, it does feel like utilities as a sector is less overvalued, and several sectors within there could offer decent yield or at least decent dividend yields relative to say some of the other stocks in different sectors. And that's important when we're at a point where central banks are looking to cut rates even further. So again, from a broad market valuation perspective, yes, you can make the argument that we're overvalued, but we do think that from a sectoral level, there are some potential opportunities to be had.
That's good to know. And something like ZUT or Equal Weight Utilities Index ETF would be a good way to play that.
Yep.
What about like large cap versus small and mid caps? Are small and mids looking a bit more attractive? And what are some ways that investors could sort of play that broadening of the market?
For sure. I mean, if you look at sort of month-to-date performance, you can see that small and mid caps have been slower to regain some of that momentum following the sell-off earlier this month. Both of those gauges as of end of day yesterday were still in negative territory, month to date, that is. But investors that are of the view that momentum and is broadening out, and they could find some opportunities in the small and mid cap space. And to be sure, I mean, there are some fundamental arguments in favor of that. Certainly, if you look at the resiliency of the U.S. consumer, and that's been an important part of why the U.S. economy is still growing at trend, despite all this talk about recessions, potential recession looming on the horizon. The U.S. economy is still close to trend growth. If this does continue, potentially you want to increase your allocation a bit towards the discretionary sector. I mean, that's represented fairly well in the small and mid-cap space relative to the broader S&P 500. So again, if you want to go in that direction, that could be one way to play it.
Okay, and so something like Z mid, Z MID, or Z small, Z SML would be good options for that. I also think, for those who are just getting started and not sure how to allocate to the mids or the smalls, something like an asset allocation that gives you an asset allocation ETF that gives you exposure to those types of stocks is also a good option to play that. So ZEQT, for example, has exposure to both of those ETFs within it. So that's an option as well. But we've recently launched buffer ETFs, and I think a buffer ETFs is similar to being like riding a bike with shock absorbers. If the market gets bumpy, the buffer ETF can provide that shock absorption, really allowing investors to participate in the markets up to a cap. And then if the underlying reference asset falls, you do have that buffer zone to limit your losses, that 15% protection zone. But it's a solution that, from a strategic perspective, that you've been an advocate of more recently. So walk us through why these might be a good option in today's market and where we stand with markets right now.
Certainly, and Aaron, it really ties into what you said earlier with allowing an investor to stay invested as opposed to really withdrawing some of their investments in the markets when times get rough. And again, I think that's a very powerful argument in favor of some allocation towards buffers. And the fact that you do get that protection of say 15% relative to the strike to the downside while still participating upwards of 10% above the strike over the following 12 months. I think that's a powerful support for a portfolio. It really does augment some of the other assets within that portfolio as well. So again, the most important part about to understand about these buffer ETFs is that they allow you to stay invested when times get rough. And as I mentioned earlier, given the amount of leverage in the system and how few triggers it takes to really lead to a pretty significant, potentially even short-term meaningful drawdown. I mean, that's a powerful factor working in favor of having buffers in your portfolio.
For sure, and important for investors to understand that it's also a 1-year outcome period, and that resets every year. So, and that the chances of the S&P 500 being down more than 15% in any given year, historically speaking, are pretty slim. So I think it's a great solution to consider. And ZJUL is our latest offering there, but we do have a quarterly ETF that you can look at as we move forward closer to October. Any other thoughts, Bipan, before we close out on the markets or asset classes that you're looking at right now?
I mean, I think there's a lot of interesting things happening in the fixed income space for sure as we get closer towards rate cuts potentially from the Fed and also additional rate cuts from the Bank of Canada, the central bank here. And what that could mean for the fixed income space is that you should see a fair degree of outperformance in the front end as the curve starts to normalize again and re-steepen. I think that's going to be a fairly prominent theme over the coming months. And again, there are opportunities to potentially look at playing that via BMO ETFs as well. We'll be writing a lot about that, and certainly it'll be something that we'll be touching on for sure.
For sure. I'm looking forward to reading more. Thanks, Bipan. That was great perspective on the markets. And looking forward to having you back again soon and hearing more from your insights and including those in our newsletters moving forward. So we will see you soon. Thanks to our audience for joining us today. And just a note that we will not be having an episode next week since it is a long weekend, but we will see you in September. Bye for now.
Thank you for watching this week's episode of ETF Market Insights. To stream any previous episode of ETF Market Insights series, please visit youtube.com/ETF Market Insights. Remember to hit subscribe and sign up for alerts so you know when we post new content. Also, we invite you to visit our accompanying website for ETF tools, education, and much more at etfmarketinsights.com. Once again, thank you for watching. The session provided is for information purposes only. Any reference to a particular company or product is for illustrative purposes only and should not be considered as investment advice or recommendation to buy or sell. Particular investments and/or trading strategies should be evaluated relative to the individual's investment objectives, and professional advice should be obtained with respect to any circumstance.